And what's up, everybody? Welcome to the official Trade Talk channel, where I show you how I analyze price for the most consistent and higher probable entries to help you guys become better traders. Today is Fed Day. That's right. Hey, if the fan is distracting, let me know down in the chat and I will turn it off. But I'm absolutely roasting in this bedroom, or office, whatever it is. How's everybody doing today? We just got about 5 minutes until we actually get the rate decision itself. So let's go to today. So we will actually get the rate decision. It's expected to stay the same at 5.5, and we'll see if they change it, which, there is a very high probability that they do not. So that's what it was when I refreshed the screen earlier. I'll refresh it again and see if it's still up there at 98.2. I can't imagine it changing a whole lot. Yeah, it's the same. So there's a 98.2% chance that they're not going to do anything. And this is the last rate decision of the year, which is fantastic, because 3 months ago they were talking about doing another hike. And now the market's actually pricing in that they are going to start cutting rates next year as early as May. So we'll see if that happens or not. Now, the actual meeting itself isn't, or the press conference isn't until 2:30. So we'll look at some stuff here. But on the rate decision, basically, we're expecting them not to do anything. Not to do anything should be construed as bullish. But we did take out a very strong high, which is, if we go to the monthly charts real quick, you can see the last high, or the highest high that was made after the all-time high, was on the monthly, and that was March of 2022. You can see that we have indeed blasted through that zone. So we have taken out that high. Next high to take out would be the all-time high, and we're only about 3 and some change of percents away from that. Let's go ahead and take a look real quick. 3.58%, and then we'll be making fresh all-time highs. Obviously, this was a very, very bullish move. You can see that it is massively overbought on the daily time frame. Not quite yet overbought on the weekly time frame, but you can definitely see there on the weekly, there wasn't many pullbacks there at all. So every single week since we bottomed here on the October 23rd weekly candle, it's just been a one-sided trade, straight up, no weekly pullback at all in that. So are we going to pull back today? Well, that's a good question. We shall see. Here are some positions that I'm currently in. TLT long. I bought the $93 call when we got the pullback on TLT the other day. Let's go get it real quick. Go back to the daily time frame. If there is anything wrong with the colors or anything, let me know. I did some adjustments on OBS because I watched yesterday's live stream and the colors were screwy. It looked all dark and ugly, so I did change some settings. So hopefully that doesn't bother anything. All right, so here was the pullback when we were red on this day. That is when I purchased the call. I bought a $93 strike call. We can go out and look at that real quick. It is Feb 16, 65 days out, $93 call. I will hold that until we reach a 1% loss, or if it continues to move higher, I'm just going to hold it. And the closer we get to expiration, around 30 days, if it's continuing to stay bullish, I will roll it out to a further date in time, as I do want to keep this position on as long as possible, because I believe that there is a ton of return, potential return, in this asset, as long as, everything continues on the trajectory we are on. Rate cuts would be very, very bullish for this. All right, because essentially when they cut interest rates, they start printing money. Printer go burr. So that should, in theory, put a lift on this. So I'm okay with the $93 strike. That puts me right around in here. I wanted to stay in it lower when we bought it down here initially, but I took profits on it as it moved higher. I should have just kept that position open, as that would have been a much better position to just hold. But we'll see if we get the turnaround. We were expecting the turnaround based on this magnificent volume that came in on these lows. You can see how much volume you had on the sell-off. And then right in here, just a massive, massive chunk of volume showed up. So that is a very good, almost like, yeah, this is probably going to do a reverse. And it did. So we'll see how long it can keep it up, or if it can keep it up. All right, it is 2 o'clock. Let's go see if they changed it. They did not. They didn't do anything. All right, yay. All right, now moving on. We are basically looking at Bitcoin to see what it wants to do from this region right here. You can see we have already liquidated yesterday's high. So what I'm wanting to see is we do have 2 closes above yesterday's high. I want to basically see if Bitcoin is able to sustain bullish momentum above that, or should we just cut and take a short right now? Let's see here. Where am I? Gimme. All right, so on the 5-minute time frame, it is moving to the upside a little bit here. I'll give it a little bit of wiggle room, and then I'll put a short on. Massive wick to the downside on the actual this platform here. You can see big wick down there, and this is weeks. This is the platform I am using for now on, basically because I cannot trade on BitGet anymore. So it looks like a decent candle. I mean, when you put a midpoint like that, I mean, I don't really want to get short just yet. It's not showing me any signs of weakness at all. And I would want to see that weakness happen at around yesterday's high, or potentially the midpoint of that big down move. I do not believe you would trade all the way back up to monthly supply, but it is possible. That's this white line right here. M supply. So the midpoint of this candle we have already hit. So now we're trading up to the 618 of this entire candle's range. So we can leave that fib on if you wish. We'll go over here and show you that monthly supply level that I took that from. That's right here, right there. Had a nice big move to the upside, closed higher. This was when it was, making that, what everybody was calling a Wyckoff distribution formation, or an accumulation. Sorry, not distribution. We were looking for distribution because it was trading back up to the all-time high, or to the yearly opening range. So we took the short, but this is the supply zone in question. It's literally the only thing that I can find that would cause Bitcoin to roll over in this area. A new level, if you will. So far right now, printing a bullish engulfing. Bitcoin is still structured bullish. If we pull up the moving averages, you're going to see that it is still structured extremely bullish. And all we've done is tested the 21 exponential moving average. And so far, it does look like people are buying it down there. We'll see, right? When something gets very, very hot like this, I see these kind of breakdown candles. It doesn't necessarily mean that it's done, that it's over, that we're just going to continue to roll over from there. If its candle would have been bigger, like a 10 or 12%, then I would probably say, yeah, this goose is cooked. But I can't quite say that just yet, as you were still trading above the 21 exponential. Where would you have wanted to be a buyer if you wanted to buy Bitcoin yesterday or today? Yep, daily support. Right there. That's where you'd have been looking to be a buyer. I know there's wicks through it, but generally all you got to do is watch the hourly time frame, drop back down there, show you basically what I'm talking about. So this is daily support right here. Yeah, I mean, you got back above it. You got back above it right there. You could have bought then, put your stop down below this low. If you think it's going to go higher, we are looking for a pullback. We were looking for a pullback on Sunday and we got it, but we haven't gotten that downside continuation yet, which is okay because an 8% day is a big move. And generally, when you have a move that large, you will see a few days of sideways price action, inside days, if you will. See how this day is inside of this day is inside of this day? Yeah. Today we're printing an outside day compared to yesterday's candle, but yesterday's candle was inside of this bearish candle. So what we're looking for bearish targets would be that low right there. But as long as the Fed is going to pause, not hike, that's not going to be very bearish for any risk assets, in my opinion. As Bitcoin continues to climb here, let's see. The SPX is up 26 points on that note, on that news, as it did make a fresh daily low not too long ago. Right there, 10 o'clock. It made a fresh daily low. Basically was trading around that area sideways. I've not taken any inside day trades based on the fact that I knew today's rate decision was coming. Now, let's go see real quick just how far away we are. So we're almost there, almost home. All-time highs. We'll see if it can get up there. I've been bullish on this asset. Once we put all this in and then consolidated the gains right through here, I was telling people to be very, very careful and watch for the breakout. And that's exactly what happened. Boom, there's your breakout. We can go back and look at the post real quick. Right here. Notice the March 2022 highs. This was done on Sunday. Volume suggests bullish continuation. Fresh yearly highs in today's breakout on the SPY. Basically, yeah, I mean, after NFP markets remain sideways, watch out for a breakout. I mean, I've been telling people for days and days to look for this right here. All right, so hopefully you were able to capitalize on that. Euro USD pushing higher. I do have an entry here. Based off of daily support, my entry was taken a little bit higher than daily support, but I got my stop way down here. Now, that does not seem like a day trade. Yeah, let's be honest, it wasn't. Right? It's a 45 pip stop loss, and basically, you know, just looking to see if this thing can break out and go back to the upside. But why? Why would you do that? Well, the moving average structure suggests support. Right? You got 50, your 100, your 200, all EMAs setting right here as price chews sideways through here. You got the breakdown, and close below, but you were unable to get bearish continuation. That suggests look for upside moves. So I took a long entry there and just waiting for this to fulfill its duties as to pay me. All right, so we'll see if this thing can move higher. Other than that, for day trades, like I said, everything's bullish. I'm long the VIX. Let's go back and see. I did put on a bearish position here, but this is for a long-term position. I sold a 4,500 put, and I bought a 4,600 put as a bearish put spread, but it is a long put spread. And then I just sold a put way out, 41.75, 93 days away, to basically finance this trade. So this is something that I can sit in for a while. Literally, this is the trade here. This is a bullish trade. This is a hedge, okay? So this is the actual trade that I want to make money on. And then this is the hedge in case I was wrong directionally. TLT's in the money, doing real good right now. PayPal finally starting to get some movement. The top two were red yesterday, the day before that, the day before that. Like, I've been sitting in red bearish trade or red trades for a long time and not able to get anything going on. This Airbnb trade that I took, so stupid. I should have waited till today, until today. Let's go over here. Airbnb. I should have waited until today to see what this thing does. I mean, yesterday you had what's called a evening star candlestick formation, right? Where you gap up, close up, and then you gap down the following day, leaving this up here all by itself. Some people call it an island top reversal. There are many different names for this specific candlestick pattern. But what I was looking for is this area to hold as resistance. And you can see post-market and pre-market, we gapped up to here, made a fresh daily high, taking out the Morningstar formation's high, and then rolling over. But you're getting a bounce. And where are you getting a bounce from? Yes, resistance. I'll show you intraday what that looks like. Right here. Boom. Tried to break down again here, and as it was going down there, I was like, come on, go down, go down. But instead, we are moving higher. But this is probably based on the rate decision, right? Airbnb was not bearish at all. Typically, these are not trades that I like to take because that's what retail traders look for, stuff like that. But the asset is bullish. Generally, we look for bullish trades when the asset is structured bullish. So I should not have taken the trade. That was bad on me. So I'll probably wait and see if this thing gets back above the open. I'll close it out for a loss, but I'm going to leave the rest of those positions on. Next position that we're going to talk about is PSTG, Pure Storage. Excuse me. Essentially, big gap down on a beat on earnings. And then on this day, I seen heavy call activity on the options market. So I decided to go in there and buy a few calls myself just to see if maybe they knew something that I didn't. And then on this day, it broke down below the support I was watching. Never mind this orange line. Broke down below the support I was watching, but I usually will give it another day or two to see if does it get bearish continuation. If it gets bearish continuation, I will close the position out. Or is this going to end up being a bear trap? And as you can see right here, we took out the high there and closed above the high, which suggests this candle is a trap. All right, so I got a $36 strike though. So I need it above $36 just to break even before expiration. The trade is up. There it is, PSTG, $22. But in order to make any actual money on that trade, it needs to get in the money. In the money. All right. So we'll see there. Yesterday had a pretty good day. Today we're doing okay as well. All right. All right. Any questions? Why we wait on Mr. Powell to set up. But Pure Storage, it's a decent company. Like I said, they stay pretty much going up. It does trade sideways a lot, so it could do that and then end up making me lose the investment, but I won't let it go that far. Once it gets down to a 1% on the total account equities value, I will close that position out for a loss, a 1% loss on the total account portfolio. All right, so Bitcoin's still moving to the upside. Do not short this. I mean, this is going to be bullish. Things that I've been talking to, as far as my main people inside the Discord, and also I've mentioned this a few times live for the regular YouTube audience. Cutting rates is not necessarily bullish. It is a bullish driver, but we've seen in the past since 2008, since the Fed literally has been manipulating the marketplace, basically once they start to cut, if they cut aggressive, you can get like 3-4 more months of bullishness, but ultimately that would be a bearish sign. So we would be looking to short the marketplace if that were to occur. What's up? Good evening, Michelle. My favorite song. Yeah, I like it too. It's a good one. Good afternoon. Good afternoon. Hello. VIX analysis, please. The VIX is broken. The VIX is broken. I mean, if you just pull up the options on the VIX, And then we go over here to the trade tab. Let's go, because the VIX is supposed to price risk on the S&P 500 out 30 days. When when you have such a discrepancy like this, your at the money calls are $2.15, where your at the money puts are 16 cents. That is a huge discrepancy. Why? Because more people are buying calls than there are people buying puts. Obviously, the VIX is a hedge play, but with 0 days to expiration options being traded on the S&P 500, it's causing the VIX to have this massive skew. Excuse me. We go look at the skew. It ticked up the last 3 days heavily. So right there was Friday, Monday, Tuesday. But I mean, it's moving back to the upside. Anything above 130 on the skew is bad. That means call prices are going to be jacked up. What the skew represents is it represents people are buying calls or selling calls and buying puts, right? Selling calls and buying puts, but not on the VIX. On the VIX, they would be buying calls because the VIX is the downside of the S&P 500. It's a way essentially to basically hedge your long positions. Let's go look at some SPX volume near term and then 30 days out, and I'll show you. I'll show you what I mean as we wait for this thing to load. Okay, so let's go first out 30 days, right? Because that's what the VIX does. It prices in volatility for this asset 30 days out. Load, you bastard. Here, let me see if I can get Thinkorswim to pull it up quicker. All right, there we go. All right, just look at the open interest 30 days out. All right, 30 days out. I mean, you got 83 contracts, 41, 35, 31, 2,000, 93, 22, 201, right? Over here, you can see that people are obviously more interested in calls as the open interest, 150K or 1,500, 283 contracts, 272, 171, 303, 536. Basically, there's more call buying happening than put buying. And then the way this thing used to trade, if you'd go out 30 days, you would see a ton of open interest here. Now let's go to 0 days and see what the open interest is on this product. All right, notice the difference, right? The open interest still isn't huge, but look at the volume. You got huge volume coming in here. Look at the volume, open interest, volume. You should have this much open interest and volume trading on the SPX 30 days out. 30 days out, right? Why? Because 30 days. Oops, I don't know what I did there. 30 days out. But they can't price forward risk because the VIX is broken. Oh, they're trading that strategy instead. That essentially means that even though the markets are bullish and everybody's happy and the market goes straight to the moon, you still have a lot of uncertainty out there to the point that like you can't even price risk out 30 days. So yeah, it's causing the marketplace to be a little bit jacked up as far as options pricing is concerned. Because the VIX is the VIX is the volatility that is priced into options products. All right. What time is the rate decision? We already had the rate decision. They didn't do anything. They paused, baby. They paused right there. So this is last month's. This is what was expected. This is what we got. They paused. We've already got the rate decision. The meeting or the press conference is at 2:30, so about 10 minutes. And he's probably going to be hawkish. He's probably going to say stuff like, we are seeing the numbers decline, but we did get a little bump on core CPI yesterday, which isn't great. That's going the wrong way. They want it going down, and it did in fact go up by 0.1%. So they're going to remain data dependent moving forward. That's what he's going to say. He's going to say that there is no rate cuts on the table. We're not even discussing rate cuts yet. It's premature to be even talking about cutting interest rates, things like that. That will be hawkish, right? But I don't think it's going to matter because the market's already pricing in that they are. And that thing is pretty accurate when it comes to, pricing and stuff like that. The market is always right. And obviously, it is very bullish. Very bullish. This was nothing more than a pullback, and people bought it right up. We can go see how it got under the 200 exponential there. Had another leg of downside just to wash out any other people trying to get long too early. Even give the bears a little bit of hopefulness, thinking, yeah, the bear market's back, baby. We're going to go back down here and take out these lows. Not this year, my friend. Not this year. Maybe next. Maybe the one after that. But this year, nope. Not happening. The Fed jumped on that interest rate hiking cycle fast. It literally, the Fed funds chart, if I pull it up, it's sticking straight up. They moved fast. If you remember, there was three F.O.M.C decisions in a row where they had hiked 75 bips. Those are big hikes. That's aggressive hiking. Very aggressive. Men look NASDAQ. Or man, look at the NASDAQ, maybe. Yeah, it's moving to the upside. That's going to be based on tech. NASDAQ's almost home. NASDAQ's 1.79% away from making fresh all-time highs. Apple has already made fresh all-time highs. Amazon, NVIDIA. Amazon hasn't, sorry. NVIDIA, Microsoft, and Apple have all made fresh all-time highs. All right, there you go. There was your all-time high. Boom. So when we breach this high, that'll be a fresh all-time high. Fresh yearly high and fresh all-time high. Things like Amazon still have not yet done it. They have made fresh yearly highs, but Amazon's still a far piece away from its all-time highs. Meta, same scenario there. Although it was very bullish, it's still a pretty good piece away from its all-time highs. Google actually opened up, traded lower. That's interesting. And then Microsoft made fresh all-time highs right there. Right? So, yeah, I mean, Microsoft and Apple both making fresh all-time highs. They're like two of the biggest market participants inside of the S&P 100. So, I mean, literally whatever they do, the market does essentially. But I'm interested to see, that both of them are down. Bitcoin's still up. But Bitcoin does look to be running out of steam. When the press conference starts here in about 7 minutes, you might get a run above the current daily high. Let's get rid of these moving averages and get over there. Tesla is one that is very interesting to me as well. If it closes above this daily support today, I might put on a bullish call spread. Bullish call spread. And we can do that out of the money. 37 days out. We can do it out of the money. Give this thing time to load up, because the breakout point is 246 and we're trading at 234. That's over like $12 of premium that we can potentially get. If the marketplace is going to remain bullish. Excuse me, I had to take a drink of water. But today's close is going to be very, very, very important. As you can see, this right here is daily support. You've not been able to close a daily under that candle since it had been put in. You have filled the gaps. I mean, I think one could argue that the gap is filled, but it's just not as strong as the other tech players. And it is kind of weird. You would think that since most of the other ones have made fresh yearly highs, Tesla would have as well. But yeah, we'll see. This does still look okay to me as far as consolidation. But if we close under that white line, then I can't buy it. Because if we close under that white line, I figure we'll probably get a test of 223.59. So we'll see. We'll see. A close above this. Have we loaded up yet? We have. So remember, we were looking for what? 245? 246? So that's the one we would want to sell. We sell that baby right there and buy this baby right here. And that gives us a risk to reward of 117 to 217 max profit. So basically you would just want to make back your $1.20, right? So you'd want to close that position out then. And the lower, we're getting a higher implied volatility as we go higher up in the strikes, which is good for the sell call. But that's a good trade. I mean, you're getting a $5 wide spread. Well, no, you're not. It's $3 wide. These are weird prices. 33.67, 33.67. Let me see if this is the same on the Thinkorswim platform. Usually it's 50 cents. Wait, where was that? 37 days out. No, it's doing the same thing. 33 and 67. 33 and 67. That's weird. Well, there you go. But we could put something on like that. But like I said, that'll be tomorrow. That'll be tomorrow. That's only if we close above daily support. Daily support 233.59. We got 3 minutes left. I'm sure Bloomberg will be talking.
50 basis points. How much do they cut in a hard line?
Or we'll cut to it. We'll see.
To his view, and otherwise the third question.
If not, then I'll have someone in the Discord put the link up for the actual Fed page on YouTube. So if you're in the Discord, if you could drop the regular Fed link. I don't know why I haven't saved that damn thing by now. But I'm sure they'll cut to it. Almost a positive they will cut to it. And we'll go from there. All right. Intel is moving higher. It's doing really, really good. I actually put some of this in the large portfolio just to the hold on to, because we literally tested the yearly opening range on this product and it held decently. So I added some of this to my HODL positions. I have an account where I don't trade it. I just buy stocks and hold them. So we'll see if this thing can keep going. I'm interested in this one, CLS, but I want to see a daily close above resistance here. If we can get a daily close above resistance, I think we could get up to $34. So you could, and this one's cheap enough where you could just literally buy one call on it. What is this? CLS. Buy one call on it and just hold it, and it won't move very fast. It just doesn't have weeklies, which is one thing I hate. But the spreads are terrible on this thing. I mean, terrible. The in the money spread isn't as bad as the out of the money spread. What is that? 25-cent wide spread? You got 30-cent. Well, it's 25 cents there as well. Yeah, that's just too expensive. People are putting positions on as we speak in this. But for me, I want to see the breakout confirmed. This right here is not breakout confirmed. This is a liquidation and a rejection. If we can't close above 28.05, it's probably going to go down. Would this be a candidate to short? No, because we're above the 50. We're looking for bullish continuation. That's what I'm saying. This could be a long trade based on the RSI. We got our 50 check right here on this candle. That would have been the ultimate place to buy it and just wait. But I wasn't able to do it as it didn't hit my radar until this day here. So yeah, if I would have caught it a couple days before here, this would have been a bought play already. We'd already bought this. We'd have bought it on the close. But we'll see if it can break out. If it can't, we'll just leave it alone. Like I said, it is not a short candidate. Nobody's really speaking in the chat, so I'm wondering if the chat is broken. Let's go see. Am I just talking to myself here?
They cut some more if needed. They cut some more if needed. So it's not sort of.
Come on.
And this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the F.O.M.C has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace.
Peter. I appreciate it.
Our actions have moved our policy rate well into restrictive territory.
What's up,
meaning
KF?
that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Remain restrictive.
I will have more to say about monetary policy after briefly reviewing economic developments.
After
recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect
keep going,
growth
baby.
to cool,
Keep going down.
With projection falling to 1.4%.
It's just going to help that TLT call.
The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%.
Yeah, that ticked lower
Strong
as
job
well.
creation has been accompanied by an increase in the supply of workers.
Went from
The labor
3.9 to
force participation rate has moved
3.7.
up since last year, particularly for
Not really
individuals
helping
aged
them
25
on the
to
inflation
54
battle.
years. And immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC
What he means by
participants
that is
expect
there's literally more jobs than there are unemployed people. That's what he means. This is as simple as that.
the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months.
Ah, you bastard, you
Came
too.
suddenly. A financial
serious?
storm no one knew was coming.
In the
That's
middle
why
of the
wise investor
freaking
turns to one of the
show.
most secure investments on Wall Street.
And it's a
For Air
non-skippable
Street,
at that.
Assured Guaranty, the proven leader in municipal bond insurance.
Businesses and
God.
forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy
26.
actions are guided by our mandate to
2
promote
years.
maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
It also helps the government with
We're
their debt.
highly attentive to the risks that high
Higher
inflation poses
interest
to both
rates.
sides of our mandate. And we are strongly
Bitcoin
committed
just
to
jumped
returning
off the
inflation to our
screen.
2%
It's up to
objective.
42,860.
As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. And we have
Bitcoin
decreased our securities
well
holders
above
by
that
more than $1
618
trillion.
retest.
Our restrictive stance of monetary policy is putting downward
We
pressure
got
on economic
a
activity and
daily
inflation.
support level
The committee
coming in
decided
at
at today's
43
meeting
to
maintain
80.
the target range for the federal
We'll see
funds
if that
rate
acts as
at 5.25 to
resistance.
5.5%,
But
and to continue the process
it's
of
moving up
significantly reducing our
like the
securities holdings.
Jeffersons.
While we
Moving on
believe
up.
that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation
Yeah,
objective is not
DXY
sure.
going to get crushed.
We are prepared to tighten policy further, if appropriate. We're committed to
Crushed.
achieving a stance of monetary policy that is sufficiently restrictive
Bet
to
that
bring
helped
inflation
that euro
sustainably
long,
down
didn't it?
to 2% over
Boom,
time,
baby.
and to keeping policy restrictive
Whoop,
until
whoop.
we're confident that inflation is on
That's
a path
almost a 2-to-1
that
risk to
objective.
reward.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going
Yeah,
forward.
we're above two
While participants do not view it as
1.
likely to be appropriate to raise interest rates further,
Since I
either
took it
they
with a
want to
wide
take the
stop,
possibility off the table.
probably not going to do
If the
much
economy
with
evolves
this.
as projected,
as it's
the
a small
median participant
position.
projects that the appropriate level of the federal funds rate
Not even
will be
a lot.
4.6% at the end
Bitcoin
of 2024,
is just keeps
3.6%
every time
at the end of
moving above my
2025,
screen.
and 2.9% at the
I need
end
to
of
just set it to
2026,
auto and be done with
still
it.
above the median longer-term rate.
There.
These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the
Data
totality
dependent.
of the incoming data and their implications for the outlook for economic activity and inflation.
Literally
as well
has
as the
not
balance
said
of risks.
anything different.
In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to.
They are prepared to tighten policy further if appropriate, and the market just does not freaking believe you, dude. It just does not believe you. You're at 44 points on the S&P 500, 45 points. That's a huge daily range for that
our 2% goal, and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential.
We just broke out of the expected weekly range high
over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
This was the weekly expected move.
Everything we do is
today. We
to
just
public mission.
Excuse me. We just breached it.
We can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Sir, are you going to cut rates? No. Rate cuts are not even in the discussion.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away
freaking reporters
from a tightening bias and toward a more neutral stance? Thank you.
No, he said that he's going to remain restrictive. And he's not taking rate hikes off the table. He already said that. He's already answered your question. Move on.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence.
So
we
more.
add any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table, so that's really what we were thinking.
All right, so that's kind of dovish.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC.
Come on, Steve.
Chairman.
Be professional.
Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate. And that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully.
Premature to be even talking about rate cuts.
We need to do more or not.
Told you he'd say that.
And that's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion.
Nice job, Michelle. Good job. 3-1. Aussie CAD long.
Give some color as to the
nice
nature of that discussion today. Thank you.
Sure. So It comes up in this way today.
Is there going to be a correction today? I don't know. I don't know.
Rate
I mean,
forecast was.
The time to get long was in the consolidation.
No back and forth, no attempt to sort of reach agreement. Like, this is what I wrote down. This is what I think. That kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And then,
it could correct tomorrow. Literally, like all of this strength that we're seeing today could absolutely be come right off tomorrow. Right.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Thanks.
I think you can say that there's little basis for thinking that the economy is in a recession now.
GDP still up above 4%. So
I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off.
The unusual situation is the fact that usually in a recession you're losing jobs. You're getting jobs cut, like people are getting laid off and fired or whatnot. That's usually what happens when you raise interest rates up so quickly. Basically, the jobs were always there. The supply of jobs is there, and this is like the first time ever that we've been in a scenario like this. That's why so many analysts on Wall Street were 50-50. 50% bullish, 50% bearish, because it's just a matter of time before the job market goes. And, we got on the NFP last Friday, it told us, no, it's 3.9. It was the highest it's gotten, and we got a 3.7. So it's going back down. There's just too many jobs out there. There are more jobs than there are unemployed people. Obviously, the jobs that are out there are going to be in the retail sector, and someone that makes $350,000 a year working for, say, Apple is not going to want to go to work at an auto parts store making $12.50 an hour. You know what I mean? So, like, those jobs will remain vacant.
In a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year. You talked about navigating
You're welcome,
by the
Michelle.
stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession.
Yep.
For
50%
for 2023. And not only did that not happen, that includes Fed forecasters.
We were bullish for 2023.
All forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong
government
demand,
spending,
but also, real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where
of course you have an open border policy on not getting into politics.
From the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the S&P from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Nope.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE
he didn't
inflation,
say lower rates
inflation,
next year.
and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices and the price level that you're expecting, and the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The S&P really is a bottoms-up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the S&P, the expectations for inflation this year, both headline and core, have come down, really significantly in
from 9.1 down to 3. That's pretty significant.
Growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down.
Well, there's a couple that haven't come back up.
Each individual writes
we
down
can go look at those.
A forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so
this isn't good.
You ask about real rates.
You're still inverted on the 10-year, 3 month.
That's something that we're
still inverted on the 10-year,
and
2-year,
and it's certainly a big part of. It's a part of how we think about things, but really is
manufacturing
matter. And as you well
still
know,
down.
It's so hard to know
right?
exactly.
They want this to stay above 50,
is, or exactly how tight policy is.
And here's your PMIs. PMIs
you couldn't follow
tick
that like it was
above
a rule
50,
and
so that's good. We need this to stay above 50 as well.
Something that we're focused on, and indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things,
you probably don't think about it, but
we just can't do that. We have to think, what's the right thing?
I mean,
we'll do
politics,
the things that we think are
politicians
right for
are the ones that
at the
put
time
you in your job, buddy.
When we think is the right time. That's what we'll always do.
You're not elected.
So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And
yeah,
as
like I said, 3 meetings ago, there was
talks about,
I think a couple people that were suggesting that there would be one more rate hike this year. But the market said, "Nuh-uh."
On the tight policy we have in place.
Not happening.
That's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So, as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf.
Exactly.
The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level with cuts beginning around March.
May.
Is this something
May,
that you are
dude,
broadly
May.
comfortable with?
May, you're wrong.
So this last year has been remarkable for the sort of seesaw thing.
It went back up.
We've had over the course of the year.
This was down.
Of markets moving
This
away
was
and moving
higher,
back and that kind of thing.
like
So
2 days ago.
And what I would just say is,
So he is
that
right. My bad.
We focus on what
My
we have
bad.
to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't. But in any case, we have to do what we think is right. And in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say.
I was going to say you're above 4%, buddy, on core
We need to
CPI.
see, continued further progress toward getting back to
4.1
2%.
to be exact.
That's what we need to see. So. It's our job to restore price stability, and that it's one of our two jobs, along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say. There is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Data dependent, month over month. That's all they can do at this
point. New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress
Amazon,
on inflation
Netflix,
alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total, as we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we're looking for.
They're saying Fed pivots toward cuts in 2024. I'm going to have to read this statement over once this is done, because he has not said that they're pivoting toward cuts.
We will get it down to 2%.
He said we're not taking rate hikes off the table. That's the exact opposite of pivot toward cuts.
And so that's how I would answer.
Rate hikes are still on the table, but the market doesn't think so.
The question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably we'll keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again.
Boom.
It just is. It's the way our policy works.
Waka chaka. No, I don't know of any options trading books. I am going to continue to put out options videos in the future to help you guys with that. I just haven't done it recently because like that's not typically where the audience goes. But I do need to get at least 15 options videos out there. I am working on them, like writing important factors for certain strategies. You got to have exact, like you can't just, on all option strategies, you got to have entry criteria, exit criteria, stuff like that. It's not as simple as just going out there randomly picking a stock and randomly picking an expiration and randomly picking a strike. That's not how option strategies work. But I am going to get some videos out, I promise. But as far as books, I don't know of any.
Better balance. What would you need to
I haven't
see
read
to
any.
prove
Let's say that. I'm sure
balance?
there's millions of them out there.
Better balance
I haven't read any.
A lot of things. It's,
I learned all this stuff on the
you
way.
see job growth.
Just be patient.
Strong,
You'll learn it on the
down
way
to
as
more
well.
Sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on.
Oh, there is a median projection of 3 rate cuts. Oh, I didn't look at the dot plot. Sorry.
They're sort of the era of.
I'm just going off of what he
labor
said.
Shortage are behind us, and they're seeing a shortage of labor is being significantly alleviated. If you look at shortages of workers.
But those are just the doves,
they thought
right?
Job availability,
the doves.
Job availability was the highest it had ever been, or close to it.
Out of all
That's
of them,
now down to more normal levels by so many measures.
But it
Participation,
is important.
Unemployment, so many measures. The unemployment, job openings, quits, all of those
Thank
things.
you for that, Tom. I appreciate it.
Wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other. The unemployment rate is very, very low, and these are. But I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
There's a pullback.
Claire Jones, Financial Times. I'd say
TLT's
the mood
rocking.
at the moment seems to be one of cautious optimism, which is somewhat
Oh, we got to close
corroborated by your
Airbnb.
forecast, by
Damn
the
it.
sense that we are going to have a soft landing.
Well, whatever.
When we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
I didn't get her.
Be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And
I didn't see a dot plot, so they didn't release one as far as I know.
So that
when I look at this, I don't see
that
that
as inflation comes down.
Economic projections, maybe
that might help improve the mood of people. But we do see those. We see those public opinion surveys.
Yeah, that doesn't
the thing
tell
that we
me
can
nothing.
do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits.
I'm sure
over such
Bloomberg
long
has it
periods of
all.
time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for, families and companies around the country.
Victoria. Hi,
Purple
Victoria
silk
with Politico.
tie.
I wanted to ask,
And an Armani suit.
on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise,
Hey,
sort of
don't
the
jinx
levels of
us.
inflation that we're
What the
seeing
hell?
now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Of course.
Sorry, if
the economy starts to
Take
looks like
a
it's starting to
dump.
fall into recession, if the jobless rate starts to rise.
Those
That's
are
not
too
something
big.
we're hoping
Yeah,
to see.
we
Obviously,
don't
we're
do
hoping
ifs
to
around
see
here.
Something very different, which is continuation of what we have seen, which
Price
is
stability,
the labor market coming into better balance without a significant increase in unemployment, inflation coming down without.
They
a
want that
significant increase in
Goldilocks
unemployment,
scenario.
and growth moderating. without a significant increase in unemployment.
No
that's what we're
landing
trying very much
scenario
to achieve.
Let alone
And,
soft
not
landing
something
or
we're looking
hard
to see.
landing.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple times. And
You're not going to get him to say
the
we're going to cut rates, because people will just clip that right there. We're going to cut rates, and that'll be plastered across every news outlet in the world, basically leaving out the actual narrative. Taking stuff out of context is what the news loves to do.
You were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
I'll take this one for you, Powell. When the data comes in line and suggests that inflation hits our 2% goal and the job growth stays steady and nice right under 4%, and we get manufacturing PMIs back up and we stay above 2% growth on the GDP.
So
maybe then
we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And,
they have to go month by month.
The two, we've come back
like everybody else.
Balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be,
but not quite there.
Very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see.
That's GDP.
It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
Every one of these reporters has essentially asked the same question over and over again.
Now with raising rates, where you basically do trial and error, cut and see what happens, or will you tie it to some
He's
particular
not going to cut and see what
progress?
happens, bro. That's not how this works.
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013.
Let's just cut and see what happens.
Screw it. These are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Edward. Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
He just said that. One person said that they could see 1.4 on the growth scale for GDP. He just said that. We're above 2 now. 1.4 is lower. He just said that.
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't
Let me say this one more time, maybe slower.
We calculate them and publish them. So it's, it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
It's sticky, bitch. It's at 4.1%, and it's been there for months.
And we've seen real progress.
Come on,
in core inflation. It has been sticky, and
if you don't, what type of journalist are you?
Stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing.
They could be talking about core PC. I don't know. Core CPI is up. It ticked up this month.
Meeting by meeting, or rather report by report.
4.1.
So, yeah.
Okay, let's go to Katerina. Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and you see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect.
Finally.
One that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean
that was their Airbnb closing.
Would need to be a little bit higher to convey the same level of restriction.
If you took that position,
we're not really
close
know
it.
That. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Retail's doing good. It's big ticket items that are not being purchased, though. That's what people are not understanding. Big ticket items. I mean, normal goods like milk, butter, bread, cereal, stuff like that, obviously, is always going to be purchased. But like big ticket items, expensive stuff, yachts, boats, new cars, trucks, big ticket items are not being bought. I mean, you can see just exactly. I mean, just look at Walmart stock. Like when they released their earnings and basically said, we're definitely not, it doesn't look great out there for the future. They took a massive hit. So yeah, we'll see.
Thank you, Chair Powell. Jennifer Schonberger.
But that could also be a buying opportunity on Walmart as well. So we'll just have to watch the technicals and see if it structurally changes. If it does, then we could potentially look to buy Walmart calls as high as 160 or sitting at 153 now. I would definitely want to see prices close back above the 156 area before I start looking to purchase calls on Walmart.
Yahoo Finance.
Or at least let the RSI correct back above 50.
that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%.
Look at you go.
Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
Closer.
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be
over restricted.
Too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while.
I don't know
for
about that,
policy to get
Mr.
into
Robert.
the economy, affect economic activity, and affect inflation.
Maybe if you go home and just click on following, you'll see them. But I mean, obviously, I don't post on Twitter every day, so that's another thing. Like, I mean, my profile, it shows that I have a lot of tweets, but I don't post every single day. I post relevant stuff when I see it, and sometimes it could be a week or so. But yeah, I don't know. I have one person in my notifications right there. That's the only person that I have with the bell icon turned on. So, and I typically get all of his posts. So I don't know if you've got the notifications turned on, you're still not getting them in your notifications feed. Then I don't know. That's an X problem, I would assume.
So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to.
I can't speculate as to the number,
because I would be able to look back then and probably find out that it turned out not to be right. But
right.
We'll be looking
because the next
and,
month it could tick back up.
Collection of factors.
You're not going to get him to say anything about rate cuts. He's not going to say the word rate. We are going to cut rates.
Stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this. We felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand, and the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
She don't even remember.
If there was something different about the U.S. economy.
Yeah, so it's not that it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And we had the view, my colleagues and I broadly had the view, that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So
and we spent trillions in stimmy checks.
Vertical supply curve to the extent demand reduced, and something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand, and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And, it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now. Just to get that out of the way.
Right.
So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
That's what he's thinking right now. So, can I go, please?
I think they're on independent tracks. So you're asking, though, the question. I guess you're implying the question of can you?
Yeah, she's very much implying when you do rate cuts.
QT, which is a tightening action, at such time as policy is still tight. And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
All right.
Chairman Powell wrapping up 2020.
Yes. That's it. 2023, that's it. No more Fed meetings, no more nothing. Same exact stuff. Just going to be data dependent moving forward as always. What did I want to look at? I guess we got the PPIs this morning. I wasn't really looking at the markets this morning because I figured they would be sideways all day, and they were. Up until the point to where he started speaking. But yeah, PPI is lower, which is good. Yeah, I mean, I don't see nothing wrong there. CPI, though, right here. Oh, they adjusted it. It was 4.1 yesterday. That number ticked up. It was 4.1 yesterday. Or maybe I'm just remembering wrongly. And then this right here ticked up a little bit by 0.1%. So this number fell, which is the headline number, but that's based on oil and food. So they want this number back to 2%. They want this number back to 2%, and then they want that core PCE number back to 2%. They want everything sitting roughly around 2%. Obviously, they're not going to wait for that to happen to start cutting rates. So as long as we continue to see a decline of those numbers, right? Core PCE, core CPI, as long as those numbers continue to come down, then obviously they're going to start looking and thinking about rate cuts. If those numbers continue to go up, then obviously they're going to leave rate hikes on the table, because if they tick back up, which not talking about the headline number, because the headline number is going to fluctuate with oil prices. And right now we know that the Americans are producing a lot of oil. Therefore, oil basically just took a dump, right? It's up today, but I mean, this has been a pretty steady decline in oil, right? And that's why you're back down to those 3% levels, 3.1%. When oil was down here, it was 3%, all right? So, yeah, I mean, as long as this continues to happen and those numbers, then obviously they'll cut rates, right? They'll cut rates. But if they tick back up and banks start to unwind their balance sheets, start to get all screwed up, and we start to see them dropping like flies, then obviously they're going to cut for that reason also. I mean, yeah, reporters are terrible. All right, so Bitcoin up almost 3% on the day. Still haven't tagged that 43,280 level. That's a level that I'm going to continue to keep my eye on as we get up there. If we are able to close the daily above it, then I'm probably just going to leave it be for now. But if we are unable to close a daily candle above that price, then I will be looking to add on a hedge for any potential pullbacks for January. All right, as we got Jan 1 right here. It's very close to us. We are just a few weeks away from the fresh new year. And I want to see Bitcoin off. I don't want to see Bitcoin up in the 40s and the 40 or the 44s and at the yearly open. However, if it stays up there and trades within 36 to 42, 36 to 42, all the way until the point where we get to the halving, then, you know, obviously people are just going to have to buy Bitcoin at higher prices if they are intending on investing in Bitcoin pre-halving or post-halving, right? So my anticipation is that it will pull back to some extent, maybe not before the first of the year, but that's what I'm looking for. I'm looking for Bitcoin to roll over slowly and steady, you know, slow and steady, just unwind a little bit, something like this, right? Nothing major, but it doesn't mean it has to happen. Obviously, if I knew what was going to happen, I would just position myself for that direction. That's not how this stuff works, right? But I am expecting it. It doesn't mean it will happen. For all I know, Bitcoin could go up to $55,000 by the time we get to the halving. I have no clue which direction it's going to go. All I have is my levels that I watch and see how price acts around those levels and take entries based upon those factors. Euro USD, nice bullish move here. I was talking about this earlier this morning that, you know, this looks like accumulation here as we have that bullish structure with the moving averages. So that's why I was expecting Euro to bounce back a little bit. Let's go take a look at USD JPY as it is coming off again. Now, this is pretty significant move today on USD JPY. And we have the BOJ next week. So if the BOJ comes out and says that they are going to hike, because the BOJ has not hiked rates in 20 years, 25 years. They've stayed at negative rates forever, it seems like. So if they get back into positive rate territory, that's going to strengthen the yen and could be a very nice positive play. But maybe not against the dollar. But if the dollar continues to unwind, then that's the one I would definitely want to see it happen at. So we'll see. I mean, we'll see what happens with this thing. But it's still had its bearish structure on the daily time frame, which is why I was looking at this as merely just a pullback. And if you look at right here, you can see that we essentially tested yesterday's open, and that would have been a fantastic place for a short. Well, I've been sitting in this long position for a couple days. It's not like I got long just this morning, because you can see you don't have a wick to my entry today. So I got long on this day here once the daily got back above daily support. And obviously I had to put my stop all the way down there based on the fact that that's a big wick, right? And I didn't want to get stopped out of the position before I was able to catch the actual move higher. And also, if you look at this on the RSI, it was staying or acting like it didn't want to breach back up into bullish territory. That put a lot of people off sides, right? A lot of people are looking at that saying, oh, it can't close above resistance. And a 21 is above it. You're under the 50, so that's a short. No, remember in the one video that I put out not too long ago discussing the fact that you can basically look at your moving average structure and anticipate what is going to happen with them. We got a golden cross right here on this. This is not a very bullish signal. It typically is looked at as a bullish signal, and we traded right down to it. I mean, that's a fantastic entry right in there. I mean, you got accumulation. You're still trading above. Just being this far under could be a bear trap, right? All of this could be considered a bear trap, but we need to see this obviously retest the 50, or it may just not even come all the way back and test the 50. It can continue to run higher. But all the moving averages are now structured in the right way. Your 21 is above your 50. Your 50 is above the 100. The 100 is above the 200. That is a bullish structure, at least for the near term. Now, obviously, that if it's going to be a trending environment, or if we have trending conditions, I did post that this morning in the Discord that I think we could potentially see the Euro USD start to trend after this meeting. Now, here's the thing. Tomorrow we could wake up and every bit of this could be poof, right? It could be sold right back off, but it would be based on a number of factors. A, the market's stretched out. B, I don't know, right? Because that was, according to Tom, FOMC median projection of 3 rate cuts for 2024 is a very bullish thing, right? Cuts leading up to the cuts is typically bullish. And if the cuts are nice and slow and easy, that will be bullish as well. So the markets will remain bullish. If they have to aggressively cut, aggressive cuts is going to be a very bearish signal. And from the chart I've shown many, many, many times of the federal funds rate versus the S&P 500, you get your rate cuts typically before the recession starts. So we can go ahead and do that real quick. And let's see here. There you go. So rate cuts typically come before. They did it in 2001. 2001 was different, right? This was a technology bust. But 2008 rate cuts came prior to prices rolling over, as that was your first cut there. What in the hell is that? Right there's your first cut. So you can see, if we stretch this baby out, that you still had 3 months of upside momentum on the S&P 500 after the cut. Well, I'm not even right there. So that was the first cut. So we had to move lower, and then price bounced up, made fresh all-time highs, and then that's when boom. But you can see that the cuts were pretty aggressive, right? Pretty aggressive, especially when we got here. It was like in 3 months you dropped a whole percent. So it just depends on how fast they cut. Will ultimately determine, if it's going to be bearish or bullish. So right there's when they started to cut. Right, we knew the pandemic was happening early 2020. So we were looking for a bearish move to happen, and it happened, and they started cutting before that. So yeah, just because they cut before, it's how aggressive. If it's just 25 basis points drop every other Fed meeting, that's not going to be bearish. If it's 50 and 75 basis point cuts every single meeting up to a full point, like that's going to be a very bearish signal. And the markets will start to see that and react negatively. But it just depends on all of that, right? There's no way that you could say, but like as of right now, rate cuts are the bullish driver for this, as well as the fact that CPI came off from 9.1% all the way down to 3. 3 is the lowest that we got this year. All right. And last year. 3 is the lowest we've gotten. We're at 3.1, and oil still has a bit lower to go before you will see that 3%. I'd say around $66, $65 a barrel, you'll get under that 3.1%, possibly even in the 2s. And if that happens, then a rate cut would be pertinent, I guess. You know what I mean? And it wouldn't be a bearish signal. It's just how aggressive do they cut? That's going to be the signal moving forward. All right. So yeah, we'll see. We'll see what happens. Other than that, you know where we're at on the Bitcoin, what we're looking for there. S&P 500, it's just bullish, right? I mean, it's just bullish. Down in here was the time to be a buyer. Obviously, when you have a nice move like this, and then you consolidate the gains, you look for the breakout to occur in the same direction. It's the same way in a bear market. Like when you consolidate the gains in a bear market, which, big move lower, spike up here, would you consider this as bullish, as consolidating the gains? No. You would look at this as consolidating the losses, and then you get your next leg to the downside. So this consolidation was very bullish. This was when you should have been looking for buying opportunities. And if you just look at the daily support, I mean, you had many opportunities to get long before this thing broke out. So I would be very careful about buying up here because, like I said, tomorrow the Fed could walk back some of the things that were said or whatnot, and then the market could finally have that pullback. But as of right now, it does look like it's marching right up there to all-time highs. Some of those things that were down, is like Apple was down before the meeting. If you remember, it's up now. Amazon up now. Meta is up now. Google's still down, which is, odd, but this may be a buying opportunity. I would have rather bought it at 131, which was yesterday's open. If I was going to buy it, that would have been the place to buy it. Or if we get a retest of this level, it could be a place to buy it because everything else is bullish. Microsoft pulling back a little bit, consolidating. This is, it's a bullish signal. It's what they call a bull flag, if you will. And look at Tesla. Freaking Tesla, I hate you. We were just talking about buying this thing, but we wanted to see it close above support here. And this damn thing ran all the way up to where we were looking for potential entries. So, damn. And Netflix, AMD, and Intel are not considered part of the Magnificent Seven. But these are essentially the stocks that are propping the market up. Netflix, big day today, up almost 4%. AMD just absolutely shockingly. I mean, that is a massive move. Massive move, very quick, right on up there, fresh yearly highs. Still not yet all-time highs, though, and Intel getting ready to make fresh yearly highs. You look to buy pullbacks on bullish assets. Anything that is moving from your bottom left to the right, top right, that is a bullish asset, and you look to buy pullbacks. Timing the pullbacks is difficult, right? Timing them can be difficult. But something like this, I mean, happening around earnings, I wouldn't have taken that trade. But any of this right in here, I would have been a buyer. I would have absolutely been a buyer in here, even though we were under the 50, based on the fact that the moving average structure is still bullish, right? It's still bullish. So you can anticipate what's going to happen with those moving averages and take positions based upon that. With that, I mean, I don't really have much else to say. Obviously, let's see here. TLT is doing really good for us. Airbnb was closed. This is a hedge for this trade here. All right. This trade will either get cut off when it hits 1% of total account equity or expires worthless. This is the one where this is the actual trade, which is what? I sold a put, right? Because I expect the market to continue to go higher. I plan on holding this TLT position indefinitely, and I'm going to continue to roll it unless it hits 1% loss. And that's just the way I manage the portfolio. And so far, it's up, but it's been struggling. It's been struggling. I mean, we've seen some really crazy moves in the last few weeks, to be honest with you. And I've taken a couple bad trades. Most of the trades that I was looking at here, this one I still believe will end up being good. Once again, I hold that $36 strike call. So once it gets above that, this trade ultimately could end up paying really big if it does end up breaking out, getting above that $40 level up there. MicroStrategy is obviously bullish today with Bitcoin, and I'm not sure if I'm going to ever even trade MicroStrategy options. The spread is in dollars, not cents. I don't like it when the spread is in dollars. Like if you got a $5 wide spread, that's huge because that's a $500 loss just by taking the trade. So you got to be very careful about what assets you do trade when you do trade options. XLF, I was looking for a pullback on this as it came into the top edge of this range. It's making fresh yearly highs. So, yeah, I mean, I'm not looking for that to go down anymore. And I closed out the JP Morgan trade as well. I was also looking for JP Morgan to potentially roll over as well, but it's following the financial sector and moving straight on up there. As far as Pepsi goes, there was a trade to be had right in here at that support because there was another bear flag right there. Or not a bear flag, sorry, a bear trap. And I've had these same assets on this list for weeks. All right. So, and they're on there for a reason where there's potential for returns. Philip Morris looks like it's if it gives us a pullback, we'll look for bullish entries. Nike took off, so I'm going to take that off. There's no point in having this on any longer as the trade happened and it's gone. The same goes for Boeing. We were bullish for Boeing. We took that trade. It happened and it's over, right? So there's no point in looking for entries on Boeing now. Northrop Grumman was still a candidate to look for long entries, but it's probably left the building. And we have Lockheed Martin, who is still consolidating this gain. So this could still be a bullish contender as long as it maintains daily support. That daily support is going to be, well, we'll move it up. At least as long as if it can stay closing dailies above 447.11, we'll look for bullish entries and ultimately a breakout. If you do get a breakout on this, measured move puts you up here around 480, 490. There's plenty of dollars to be gained in this trade if we can get it as support and if we can get it to break out. Just always keep oil on the list because we can take intraday trades on oil. Tesla was another one we were watching at daily support. Maybe it pulls back a little today and we can ultimately look for that spread that I put on earlier and see if we can get a fill on that. Upstart trade's already worked out. I was looking at it down in there, so that could be taken off the list. Hell, it's up 17%. Amgen, yeah, this one didn't give me much time either. It's already ripping today as well. But there's your breakout. See, I didn't want to take it. It was down in here is where I was looking for the entry. But yeah, breakout. Look at this retest of old resistance. Like that would have been a perfect entry for a breakout retest, right? You broke out on this day, but you closed under. But on the open, you came right back in, tested that to see if it was going to act as support. That's what people say whenever they say resistance flipped as support. That's what we're talking about right there. You open above what was resistance, you retest it, that's your buying opportunity. Kraft Heinz. Oh, sorry, this is Coca-Cola. I think I took the Kraft Heinz trade off as well because we already closed that position. This one's no good anymore. Philip Morris, maybe still on the table, Pepsi, and then, yeah. But here is the Kraft Heinz. I think it's, no, what is it? There it is. KHC. We got long on this thing, right? We got long on this thing right in here. And look at it go. Boom. Up. This is a very slow moving stock though. So it took a long time for us to make. I took the profits when it hit above 50%. No, 100%. Sorry. The position made 100%, not 100% equity on the account. Just the position itself paid out 100% worth of profit return. So obviously that one's not on the list anymore. But I looked through the stocks. I looked through at least 100 stocks every single day off of the S&P 100 list. It's too hard to look at 500 stocks every day. So what I do is I'll scan for specific setups and stuff like that. But when we find more potential things that we can look for bullish entries or bearish entries for that matter, I will keep you posted. Has anybody got any questions? Thanks, Heath. You're welcome, Michelle, for whatever I did. ADA at yearly high. Let's go look at it. Yeah, fresh yearly highs on Cardano. Nice. Nice work. It's up pretty good on the year. 172%. So obviously I wouldn't be looking to be a buyer of it now, especially since it's massively overbought. But looks like, I mean, if you close where you're at or lower today, you're going to be printing bearish divergence on the RSI. So just keep that in mind. The breaking news text is doing him dirty. Yeah, it is. It was, I should say. Yeah, and price stability, yeah. Trying to keep up with your posts on, oh yeah, I kind of mentioned that in the actual live stream. Where would you buy Bitcoin for an intraday trade if you wanted to go long? Today, I would not. The trade has already happened, my friend. It has already happened. If you're looking for long entries now at 3 o'clock in the afternoon, you're doing it wrong, right? Entries, the best entries are going to be, if there isn't any news, obviously, in the morning. That's where you would be looking for long entries. And I only always look for long entries at or around daily support. Now, if hourly support forms under daily support, you could work with that. But I can't buy it here. And I definitely can't short it here either. If it doesn't get up there and reject, then I'm not shorting it, because that's monthly supply. If it does get up there and reject, then I will potentially be looking to short Bitcoin for a hedge, to hedge the long trade, obviously, or what I hold on cold storage. USD JPY, a few people asked me where was I looking for it to pull back to. I said watch the Q3 open or Q3's high. We should be setting at $11. We should be setting at $11. I mean, that's the pandemic. This was the bear market of 2022, and you're under those levels. But we haven't quite yet made all-time highs yet on the S&P 500. But pre-pandemic, a normal VIX was $9. So there's still a little bit of room for this thing to go back to the downside, but not much. So there's just better ways, I think, to make or to trade if you're looking for hedges on potential downside risks on your S&P 500. You can sell calls, or you can buy puts, or you can sell a call to finance the put, or buy a put spread. There's just many different things that you can do to hedge risk. You don't have to buy the VIX. You're going to be paying an extravagant premium on the VIX right now based on 0 day to expiration option trading. USD CAD moving down. This is going to be due to a little bit of CAD strength, but ultimately it's going to be dollar weakness. But you can see CAD is up today. It's 0.068%. So Canadian dollar right here holding. You're above the 50. So could be looking for more shorts on USD CAD if we get a pullback into a resistance area, say 1,357.40. I wouldn't short it down here because you're at support. Never short at support. Wait for it to pull back, maybe to supply, then look for the short, or even to the wick. All right, you can watch the wick even as if it is going to continue to go lower. You might not even get a pullback for a couple days. FX can do that, as you can see right here. Multiple days up without giving you entry opportunities. So pound dollar is not as bullish as, say, Aussie dollar, which is up 1.6% on the day. What in the hell is going on over there? Aussie is a risk-on asset, so probably start looking for bullish entries on this if and when you get pullbacks. Not now. Obviously, you're into resistance. You don't get long at resistance, but we'll see how it plays out. Yen trades, I'm still kind of waiting to see if the BOJ hikes. If the BOJ hikes, then I'm going to get long the either by using yen futures or just stay short USD JPY. However, I would rather play a Japanese yen strength trade on yen futures, as you're not really, it's just the yen futures themselves. So we'll see how that works out. But I think if they do that, which that's a big if, they mentioned it, and that's why we initially got the pullback. But this thing is massively oversold. I'm talking massively. I mean, it's at overbought levels now, but I mean, looking at the long-term chart since the pandemic, this little spike up here is your pandemic. You're massively oversold. So there could be a little bit of yield to earn here, only if they raise interest rates. If they leave their policy the same, then this will get sold off. It'll get hit right back down. Thanks, Heath. Onwards and upwards. LOL. Yep. Didn't manage to get any positions on this week, but I am still long ADA from 0.2887. It's my only trade currently. Hey, it's doing good. It's up. I think it was up in the 60s, so you're doing fantastic. There's nothing wrong with that. Yeah, 63 cents. You got in at 20. You got in at a very, very good level. 2.8 puts you in this area in here, which is, yeah, you got a pullback right there. One daily support, and you got another pullback there. So good job on that. Good trade. You don't have to be in multiple trades. Sometimes being in multiple trades will actually do your portfolio negative. As you can see, I'm down, right? Like, I'm up on the year. Obviously, we're up almost 20% on the year. So we're beating S&P 500 currently, but it's been a struggle because I keep many positions open, and some win and some lose, right? But lately, a lot of them have been losing, at least for the past couple weeks. But the fact that I nailed those good ones is keeping it, afloat, or in profit, you should say, or up on the year, right? And that's the goal for any trader. That's the objective. Beat the S&P 500. If you can consistently do that year over year, you will be in the top 5% of traders. And if you guys continue to follow the channel, make sure you hit subscribe, like, all that stuff. I will help you get there. I will help you learn how to do this. Obviously, you got to stop doing all the bad things that you yourself is doing to yourself, if that makes sense. Like overtrading, revenge trading, forcing your bias upon the market, stuff like that. Like, all that stuff's going to kill your account. It's going to wreck you. You got to learn to break those habits. If you can break those habits, I can turn you into a profitable trader. But it's up to